Welcome to Finademy course of Stock Basics. Our topic today is bulls, bears, and market sentiment. Use the link in the description to download the app on the App Store for more courses and free practice tests. Number 1. Investors often have differing opinions about particular stocks or about the direction of the economy as a whole. Each trading day is analogous to a struggle between optimists and pessimists who buy and sell at various prices given different expectations. The stock market is said to incorporate all of the information that exists about the companies it represents and that manifests itself as price. When optimists dominate, prices trend upwards, and we say that we are in a bull market. When the opposite is true and prices trend lower, we are in a bear market. Answer the question. When optimists dominate, prices trend upwards, which kind of market are we likely to be in? A. A bull market. B. A bear market. C. A black market. D. A stable market. The correct answer is A. A bull market. Number 2. A bull market is when everything in the economy is running objectively well. People are finding jobs and unemployment is low. The economy is growing as measured by gross domestic product, GDP, and stocks are rising. Picking stocks during a bull market is arguably easier because everything is going up. If a person is optimistic and believes that stocks will go up, he or she is called a bull and is said to have a bullish outlook. Bull markets cannot last forever though, and sometimes they can lead to dangerous situations if stocks become overvalued. Answer the question. Which is not true about bull market? A. Stocks are rising. B. The economy is growing as measured by gross domestic product, GDP. C. Picking stocks during a bull market is difficult. D. Unemployment is low. The correct answer is C. Picking stocks during a bull market is difficult. Number 3. In fact, one severe form of a bull market is known as a bubble, where the upward trajectory of stock prices no longer conforms to fundamentals and optimistic sentiment completely takes over. Historically, bubbles have occurred regularly dating back to the Dutch tulip mania of the 1600s, where the price of tulip bulbs rose so high that one could be worth more than a house, through to the housing bubble of 2008 that sparked the Great Recession. Bubbles always burst when reality catches up with overinflated prices, and people often realize bubbles in hindsight. It is difficult to recognize when investors are in a bubble, and even harder to predict when it will pop. Answer the question. Is it true that it is difficult to recognize when investors are in a bubble, but easier to predict when it will burst? A. True. B. False. The correct answer is B. False. Number 4. A bear market is informally defined as a 20% drop in broad indices. Bear markets happen when the economy appears to be in or near recession, unemployment rises, corporate profits fall, and GDP contracts. Bear markets make it tough for investors to pick profitable stocks. One solution to this is to profit from when stocks are falling via short selling. Another strategy is to wait on the sidelines until you feel that the bear market is nearing its end, only starting to buy in anticipation of a bull market. Answer the question. What is a bear market informally defined as? A. A 5% drop in broad indices. B. A 10% drop in broad indices. C. A 20% drop in broad indices. D. A 30% drop in broad indices. The correct answer is C. A 20% drop in broad indices. To learn the full course, please download our free app Finademy on the App Store. Thanks for watching. Don't forget to like, share and subscribe to our channel for updated videos every week.